Hello and welcome to Business Morning here on France24. Let's start with a look at today's main business stories in the world's press. Iron price surge hits Asian firms, says the Wall Street Journal. This Tuesday, Japanese and South Korean steelmakers have agreed to pay Brazilian miner Vale 65% more for iron ore this year. The paper says the move is boosting the fortunes of big mining companies at the expense of steel producers and their consumers worldwide. Well, we'll have more on that story in just a moment with our business editor, Douglas Herbert. The UK's Financial Times reports that US banks have been quietly borrowing some $50 billion from the Federal Reserve via a new credit facility. The scheme, which was introduced 2 months ago to ease the credit crunch, allows banks to borrow money at a relatively attractive rate against a wider range of their assets than previously permitted. The Fed has not yet said how long the measure will remain in place. And the French business daily La Tribune displays a two-page spread on weapons sales in the world, which, apart from Europe, are on the rise again. The paper says the Asia-Pacific region has become a big market for exporters, while Middle East countries are using their oil revenues to buy more high-tech materials. Although the United States remains the leader in that sector, it's now facing tougher competition from countries such as China and India. Now, as promised, we'll get back to our top headline. The world's biggest mining companies are reaping the benefits of surging demand for iron ore from Asia's boom economies. With more, I'm joined by our business editor, Douglas Herbert. Tell us all about it, Doug.
Catherine, let's think of those soaring steel and glass skyscrapers in Shanghai, the factories sprouting up across southern China, and all of the highways needed to ship the stuff they produce. Now, this is the infrastructure that is driving Asia's breakneck growth, and you need steel to build it. And to make steel, what do you need, Catherine? You need iron ore. Iron ore is the essential raw material in steel. Demand for iron ore has risen about fivefold since 2001, and it does not seem to be abating anytime soon. There are three mining giants. This is sort of incredible. Three companies that supply about 70%, almost three-quarters of the world's iron ore exports. They are two Anglo-Australian giants, BHP Billiton and Rio, now caught up in a big hostile takeover battle. The third one is Vale of Brazil. This is the company that has just finished the yearly round of negotiation with big steel makers over the iron ore prices for the year ahead. Usually one company negotiates and the others go along. The Chinese will accept and whatever they come up with. This year might be a little different. A 65% increase was agreed on for iron ore from the big Japanese and South Korean steel companies. And those companies actually rallied yesterday on the stock exchange. Why? Everyone expected that the increase was going to be even larger.
This deal was hammered out by the Brazilian miners. Are Rio and BHP going to go with the agreed price?
You know, normally they would, but this year might be a little different. The thing that sets them apart from Vale is Rio and BHP, they are based in Australia. They're very close to their main markets, the Chinese and Asian markets that they supply. Because of that, they say, we want a freight premium. We want a little more. So they're expected to push for perhaps even maybe up to 75% increase. Obviously, the steel makers themselves could pass that on to companies. We could see higher prices for steel products. It could be anywhere 22% higher. Their margins are being squeezed.
And that means our business editor, Douglas Herbert, is going to need nerves of steel in the months to come. Well, we stay in Asia now for our daily update of business news in the region with our Beijing correspondent, Henry Morton. Today, we start with China, which the rest of the world still regards as the place to invest, Henry.
Yes, year-on-year foreign direct investment in China more than doubled in January, adding to a flood of cash that's already threatening to overheat the world's fastest-growing major economy. Spending by companies and individuals jumped 110% to $11.2 billion, continuing the upward trend of 2007, which saw investment increase 13.6% to $74.8 billion. The increase further adding pressure to the government as it tries to fight inflation that's hovering around an 11-year high. We move to Japan, where the country's largest oil exporter, Inpex Holdings, will increase investment in overseas oil and natural gas projects by as much as 50% a year as costs continue to climb. Annual spending on projects abroad may increase as much as $2.8 billion over the next 3 to 5 years. That's up nearly $1 billion from a capital expenditure forecast a year ago. The money will help Inpex further develop its new overseas flagship venture, the Ichthys liquefied natural gas project in Australia, Australia, which it's looking to start deliveries from in 2012-2013. We end in South Korea, where the number of new job offerings fell to a 2-year low last month as companies continue to remain reluctant to hire new workers amid an uncertain economic outlook. 235,000 new jobs were offered in January from a year ago, well short of the government's target of 300,000 and a 7th consecutive monthly fall. Those then are the stories making the business news here in Asia today. Back to you in Paris.
Thanks, Henry. Now, German postal company Deutsche Post has named a new chief executive after its former boss, Klaus Zumwinkel, resigned over an implication in a major tax evasion scandal. The affair has been rocking the country since last Friday. Mr. Zumwinkel is suspected of not paying €1 million in taxes by using banks in Liechtenstein. But the scandal is much wider than that, and hundreds of tax fraud suspects are being targeted by the finance ministry now. Several banks and offices were searched in Munich and Frankfurt on Monday. Here in France, hundreds of thousands of jobs have been lost in the industrial sector in the recent years. Now, a recent rash of factory closures has led some experts to ask the government to step in to prevent France's heavy industry from disappearing altogether.
A crisis in French industry. Manufacturing heavyweights ArcelorMittal, Arc International and Michelin Kleber have all announced hundreds of layoffs. And at Ford's French subsidiary, 2,000 jobs will go by 2010. In the last 6 years, 500,000 jobs in the French industrial sector have disappeared, 50,000 last year alone.
Ford has decided to close this factory. I keep seeing companies closing down. What is France becoming? Nothing but a tourist destination?
It worries some experts, but others see it as an inevitable part of the evolution of the French economy.
When we talk of deindustrialization, we're talking about a drop in employment in the industrial sector relative to other sectors. And that's not bad news, it's the arrival of the post-industrial society.
50,000 jobs lost in industry last year, but 300,000 new posts were created in the service sector. France has already lived through a wave of factory closures. In the 1980s, the socialist government nationalised factories and banks and spent billions of euros propping up ailing industries, a practice that's since been abandoned. But as a presidential candidate, Nicolas Sarkozy promised that if elected, he wouldn't let French industry die.
I believe in the factories and I think that France has to keep its factories.
A promise that may be hard to keep. In the era of globalisation, French workers are becoming less and less competitive.
Before we close this edition of Business Morning, let's have a quick look now at the stock markets. Wall Street was closed on Monday on President's Day, but here's where the Nikkei is standing in Tokyo right now. And that's it for this edition of Business Morning. Stay with us on France24.